Well, hello, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar where we'll be discussing year-end tax planning, considering the Tax Cuts and the Jobs Act bill. Now, I'm very pleased to have with us this afternoon Robert Green, who is a CPA, as well as the CEO of GreenTraderTax.com. Well, Robert, I hear you in the background. I want to thank you for joining us. And what I'm going to do is actually, let's make you the I'm going to pass the controls over to you. So let's go ahead and get underway here this afternoon. Thanks for joining us, Robert.
Thank you, Cynthia. Welcome, everyone. This is year-end tax planning considering the Tax Cut and Jobs Act bill, November 9th, 12 p.m. Eastern. I say that because in just a few hours from now, the Senate is going to probably release to the public its tax bill, and then, of course, the House and Senate will go into conference to reconcile the two. I'm managing member of Green, Neuschwander & Manning, LLC, our CPA firm, and CEO of GreenTraderTax, our website and content company. We focus on traders. Trading is a real profession, and other tax professionals and solution providers underserve them. Traders deserve tax advice from CPAs and tax attorneys who are acutely aware of different tax laws and regulations that apply to them. We're going to discuss that today. Wash sales, avoiding them at year end, tax loss selling, all sorts of things that investors and traders need to deal with. Mostly focused on individuals today. We have another webinar coming up in a few weeks on business. But you won't get this from your local CPA oftentimes. They don't understand trader tax status, Section 475, Forex tax treatment. And we always write about that. And if you see my recent blog posts, they're about the impact of tax reform on traders, investors, and investment managers. I'm considered a leading authority on trader tax and an advocate for traders. You can see my Green's 2017 Trader Tax Guide. The 2018 guide will come out in January, hopefully including finalized tax reform. I'm an ongoing contributor to Forbes. All my blog posts appear in Forbes. I wrote the Business of Trading column for Active Trader magazine for 14 years until the magazine closed. And leading brokerage firms like Interactive Brokers feature my content. You'll see me frequently interviewed in all the leading media. But enough about me. You're the hero trader. I'm just your guide showing you how to avoid sometimes the villain, the IRS, to lower your taxes and deal with all these issues. Now, this information today is educational. It's not one-on-one tax advice, which is what I recommend that you get. I'm a CPA. I'm not an attorney. I'm not a financial planner. I'm not an investment manager. I am not affiliated with Interactive Brokers. They are a brokerage firm. We are a CPA firm. As a sponsor, they call us. We don't pay. But the point is that they feature our tax content, and we've developed a nice relationship over the past couple of years, or a year plus. Now, I prepared today's presentation based on existing 2017 tax law and the House Tax Cut and Jobs Act H.R. 1 bill released on November 2nd. I updated the slides when they did the Ways and Means amendments on Monday, and it's primarily effective for 2018, the tax cut bill. So we're talking about using current law for this year and planning, with an eye out for tax changes that mostly happen in 2018. There's only a couple of provisions that they allow to happen in the House now, which is like full expensing and the trimming of the mortgage deduction. But for the most part, tax reform is something that's happening in 2018, and we're doing tax planning based on year-end 2017. So as tax reform advances through Congress, the House came out with its bill. The Senate comes out with its bill later today. They go to conference. They negotiate. The White House chips in. it's safe to assume at this juncture that your tax rates may be lower in 2018. After all, that's what tax reform is. It's all about lowering the rates, expanding the base by getting rid of deductions, mostly for individuals, and that's unfortunate. So some of your expenses will likely be repealed. Exactly which ones, they're going to still negotiate that. But for the most part, they're going to be repealed. So it's probably wise to use the time-honored strategy of deferring income, deferring your wages, your capital gains, your business income, bonuses, and accelerating payments to deduct them while you can. You don't want to go overboard prepaying too many things because the IRS may not agree to that. But you certainly want to pay what you can before year end to get a deduction, because that deduction may disappear on you next year. Now, even if Congress can't get their act together and fails to pass tax reform, you'll benefit from the time value of money. Why pay taxes this year that you can pay next year? You can trade and invest those monies for another year. The Tax Cut and Jobs Act, H.R. 1, this is from the House released H.R. 1 on November 2nd. It's important to consider this bill when doing 2017 year-end tax planning. From what I've gathered about the Senate bill that's being released today, because it just some news came out in the Washington Post and otherwise, they informed their conference at 11:30 at the public later. They want to trim the deductions even more. So it's a very similar bill. Some of the timing issues are a little different. I'll mention that to you in the slides today. So the House released its bill, and I wrote 2 blog posts about it over the weekend, how the tax cut bill impacts traders and investment managers, why the tax cut may disappoint owners of pass-through entities. So if you're a service company or a trader or investment manager, you're not getting that 25% pass-through rate. That was a mirage. That was really, I think, inappropriate advertising of the bill. If you were a manufacturer, you at best would get 30% of your income at the lower rate. So that meant it was in a 35% bracket, it was 32%. In a 39.6% bracket, it was 35%, not 20%, 25%, excuse me. And service companies and traders get nothing. They don't get the PTE rate. The Senate is expected to release its tax reform today, and I prepared this PowerPoint deck on November 6th, sent it to IB compliance. That takes a few days, so I can't make any last-minute changes. That wouldn't be fair to IB compliance. The House tax bill repeals itemized deductions. You know, it's so funny, they talk about reforming the code. They're just getting rid of some itemized deductions, which people really like having. It's not a lot of reform, in my opinion. The code is still extremely complicated. This tax bill itself is 429 pages, and it's making tremendous complication headaches on some of the things that they're doing. So they want to get rid of the state and local income, sales, property taxes. They want to hit those high tax states. Now, also they're getting rid of medical expenses, casualty losses, unreimbursed employee business expenses, and tax compliance fees. Now, when they first talked about making the changes, they said, we're getting rid of all itemized deductions except for mortgage and charity. But that's not how it went down in the act. There were a few expenses that they kept. They just didn't talk about it. One of those are investment expenses and investment interest expenses. So they're getting rid of the state and local income, sales, personal property taxes, medical expenses, casualty, unreimbursed employee business expenses, and tax compliance fees when you pay your accountant. They're getting rid of AGI deductions for alimony, but your spouse doesn't have to pay income on the tax on the alimony. Getting rid of moving expenses, student loan interest, tuition expenses. They consolidate the education credits, but they they're hurting students. They're hurting people with medical bills, casualty losses. And they didn't trim the business expenses much. They took away the entertainment when you go to the, you take your trading partner to, a sports game. The dinner you can deduct, just not the sports game. Now, they modified a few itemized deductions. After a lot of blowback about the state and local, you have a lot of members in high tax states, Republicans, and they said, no, we need something. So they made a deal to keep the real property tax limit to $10,000 per year. Now the Senate, I understand, is not going to do that. They don't have members in their conference in the high tax states. They're Democrat senators, and they just want to go for the whole thing. But the House did cave in and gave $10,000 property tax, which works in Texas where you don't have income tax, but there's property tax. Brady's in Texas. So that's one thing the House caved in that the Senate is not expected to cave in on. The mortgage interest is limited to a mortgage of $500,000 on new home acquisition debt originated after November 2nd, and only on the primary residence. Existing mortgages before November 3rd are subject to the prior limitation rules, up to $1 million on primary and second home and $100,000 for home equity loan. So that's when the House bill dropped, that day, November 2nd. So if you're going to get a mortgage the day after, rushing out to try to beat the clock, it won't work. So they wanted to trim the deduction down in half. Now, I understand the Senate, after a lot of blowback from the real estate industry, is not going to do that. They're going to keep the $1 million. But let's see later today. So bottom line is you're probably facing a lot of repeal of deductions and modification of others. And you want to get the deduction while you can. So as you go into this year end and you start getting bills, you want to pay what you can before year end if you're on the cash method. You don't want to delay until next year. Now you have to use prudency. If you get a property tax bill that gives you the option to prepay all of next year and it's on the invoice, perhaps you can do that. But you can't do that on prepaying mortgage interest and other items. You have to consult your local accountant and not go overboard. So again, in exchange for lowering business taxes, which is really what tax reform is focused on, that's what President Trump wants. He really wants to beef up the economy, help job creators, businesses, because he feels there'll be trickle-down economics, that businesses will raise salaries, increase paychecks. Now, Democrats don't believe in trickle-down economics. They think that businesses will use the savings for buybacks, executive compensation hikes, but not necessarily hiking wages. That's a classic argument. I don't want to discuss politics in any way. I don't want to give any editorial commentary. I want to just stick to the facts. The House tax bill repeals many itemized deductions. So the notable exceptions, and they didn't mention this, you know how you know it's an exception? It disappears in the middle of the night. It's not in the final wording. The notable exception was investment expenses, investment interest expense, capping of the property taxes, capping of the mortgage. So the House tax bill compensates middle income folks by doubling the standard deduction. That's the big argument. We're getting rid of a lot of deductions, itemized deductions, but we're giving you a beefed up standard deduction. That helps middle income folks, may not help rich folks much. And it's a little tricky how they get rid of the personal exemption and then put that into the standard deduction. It's not double in the end. It's not double. So what you want to do is bunch your deductions into this year and itemize, and then figure your deductions next year are less than the standard deduction and take advantage of that. Have your cake and eat it too. So you should try to pay all 2017 expenditures before year end to get the deduction while you can, to reduce 2017 income, which might be at a higher tax rate. Miscellaneous itemized deductions. The tax reform framework repeals tax compliance fees. So if you get, if your accountant gives you the opportunity to prepay, let's say you want to do year-end tax planning for 2017. Well, our tax compliance service includes planning and preparation. So we would do the year-end planning and do next year's preparation. You can prepay your CPA before year-end to get the deduction. Now, if you have a business, it's going to be a business deduction. No worries about that. It's still better, remember, to lower your income this year. Now, this is an important one, the unreimbursed employee business expenses. You're an investor, you're a trader, you have your IB account, but you also have a job, and you have unreimbursed employee business expenses, where those, plus your tax compliance fees, plus your investment expenses, can get you over the 2% miscellaneous itemized deduction threshold to get a nice deduction before AMT wipes it out. Now, AMT is a big factor this year. It's not going to be a factor next year. It's repealed. And that's part of the reason why they're getting rid of some of the deductions. It's all integrated with the AMT. So, but back to the bills. You should try to pay service providers for 2017 services before year end. Traders who are eligible for trader tax status have business expense treatment bypassing miscellaneous itemized deductions. They don't need to worry about this problem of the miscellaneous itemized deductions. So back to the employee business expense. Employees should submit expenses to employers for reimbursement before year end, since the accountable plans are use it or lose it. So your employer has a reimbursement plan, but you must use it or you can't, or you lose it, the benefit, before year end. Now, under current law, your miscellaneous itemized deductions are deductible above a 2% AGI threshold. You may not be over the AGI threshold. If you make $200,000, it's $4,000. And plus, if you are over, AMT may wipe it away, because if you're paying AMT tax, it's not deductible for AMT. So here's the key thing. If your employer doesn't have an accountable plan, encourage them to consider one for 2017 and 2018, because otherwise you're going to lose you're going to lose all the deductions next year, and you're going to lose some this year. But if they have an accountable plan, you're going to get all the deductions. So you need employers to react to tax reform to beef up their accountable plan policies. For your investment expenses, this year you want to make sure you're over the 2% AGI threshold. Investment expense, tax compliance, employee business, over 2%, and that it's not wiped away for AGI. Next year, your investment expense seems good to go in the House bill. With your mortgage, with your charity, with those three, and investment interest expense to the extent it exceeds investment income, you need to get over the standard deduction amount. What a lot of people didn't like the real estate industry didn't like about the bill, is sure, you let them have a mortgage deduction, but it's kind of orphaned. Just that alone in the charity might not be over the standard deduction. So a lot of people may feel, I'm not going to go the extra mile. I have such a far way to go to get over the standard deduction, because I can't deduct my state and local. So I'm not going to give a lot of charity. I'm not going to get the big mortgage. So that's why there was blowback. Even though that they made the cut, they feel that people would not go in their direction because they wouldn't try to exceed the standard deduction. Now let's move on to a big area, the state and local tax deductions. You want to accelerate those deductions this year. The House tax bill repeals itemized deductions for state and local taxes, including income, property, and sales and use taxes. Property is not real property. Property is like in Connecticut, you pay on your cars. In some states you have a tangible property tax. The House allows real property taxes up to $10,000 per year for 2018. If you have more, you want to try to prepay some of it in 2017. Now, the Senate bill, I understand, it may not allow anything there, so you may want to prepay as much as you can this year. When you get that bill from your town, city, community, you want to see what's on the bill that you can prepay. For 2017, you can elect to claim sales and use taxes as an itemized deduction instead of state income taxes. That's what you would do in a tax-free, income tax-free state like Texas. Now, normally with tax planning every year, you think about the Q4 estimate and whether you want to pay it before year end or by January 15th. So you want to pay the state income taxes in 2017. The House tax bill repeals state and local income tax deductions and AMT starting in 2018. So your best chance at a deduction might be to pay state and local income taxes due by December 31st. Local is like New York City has an income tax. So you want to do your year-end tax planning, see what you're going to owe state and local income tax, and write that check and mail it by 12/31. Don't even think about changing the date to January 15th or waiting till pay on April 15th if you don't have an underestimated tax penalty issue. Think about clearing out the books. Even if you think you're not sure if it triggers AMT or not, you may as well, I mean, if you know it's going to be wiped out with AMT and you want to hold the money longer, then don't bother. But it depends on how good you are with a draft tax plan. A lot of our clients will work up a draft tax return and make informed decisions so that they don't leave money on the table. Now, this is a change from previous tax years when individuals may have postponed state and local taxes to avoid AMT. So if you knew by writing the state a check of $10,000 or $20,000, $30,000 on 12/31 that, hey, I'm paying AMT, I'm not getting the benefit here, I might as well date it January 15th because hopefully I won't pay AMT next year. If your income's low or super high, you're out of the AMT danger zone. But it's different this year. You want to try to go for it this year and err on the side of prepaying rather than postponing. Be sure to check the latest developments on tax reform before you make this decision close to 12/31. So you're sitting there right before the holidays kind of deciding on what you're going to pay the state and city if you owe the city. And you want to see what's the latest with tax reform. Did it burn out? It's not going to happen at all. They couldn't get their act together. There was too much blowback. They couldn't get the 52 Republican senators. There was, some dropped out because of this or that change. So you want to wait until you see the latest news. And hopefully we will see where they stand going into year end, because I think by Thanksgiving we're going to kind of see some of the negotiations. The House and Senate got their bills out, although I understand the Senate doesn't even have legislative language today. It's more like framework talk again. Casualty loss deduction. Wow, people have a lot of casualty losses this year with the horrible hurricanes and wildfires, and my heart goes out to all of you that have had this problem. The House bill repeals the casualty loss itemized deduction for 2018. So try to complete your claims to support a 2017 tax deduction. Now keep in mind the 2017 disaster tax relief bill for Hurricanes Harvey, Irma, and Maria victims exempts qualified disaster-related personal casualty losses from the 10% AGI threshold. So normally you can only deduct the loss over 10% of your AGI. That's waived. But even more interesting, the hurricane victims also don't have to itemize they can add this casualty loss to their standard deduction, and that part is deductible for AMT as well. So I'm hoping next year, if we have more of these devastating hurricanes and wildfires, that Congress has empathy and gives this type of disaster relief where people don't have to worry about that the casualty loss deduction disappeared. It's kind of bad timing on the part of Congress to take away this deduction. Now you want to maximize charitable contributions before year end. Now, they're keeping charity for next year, but without your state and local tax, if you have a low mortgage interest or with a cap on the mortgage interest, without your miscellaneous itemized deductions, maybe you don't have many investment expenses. Maybe you're not going to get over the standard deduction next year. So why not bunch some of these deductions into this year? So you should make tax-deductible donations before year end by check and credit card. Property donations of clothing, give those to Goodwill, Salvation Army. Household goods, the same. You can donate appreciated securities. Those can also be deducted. Now, the itemized deduction is calculated based on the fair market value of the property that you donate. If you're giving it to like Salvation Army or Goodwill, there may be other acceptable methods like whatever price you're going to put on the goods. When you deduct the fair market value of appreciated securities, you avoid capital gains taxes. This is what the super rich do, the billionaires. Warren Buffett is the poster boy for this. You donate your appreciated securities to charity. You get a deduction at the fair market value. It wipes down your taxes so low that you get into AMT issues. Because otherwise you have like long-term capital gains. You don't have much ordinary income. You never have to pay the capital gains tax on what you donate. It's a wonderful thing of these people to donate so much money to charity. So you guys may want to consider some of that too, donating appreciated securities if they've been up this year. You don't have to pay a capital gains tax. You don't have to worry about, it's sort of like a double dip benefit. Now, make sure you adhere to the rules, and you can make charitable contributions from IRAs. The IRS permits individuals aged 70 and a half or older to make charitable gifts up to $100,000 per person per year directly from their IRAs. The strategy is more tax efficient than taking an income distribution, which is taxable, and potentially losing some of the deduction with the piece itemized deduction limitation for upper income taxpayers, where your upper income, you're disposed to doing large charity. Don't take the money out of your IRA, pay taxes, then have a charitable deduction that's limited with a piece itemized deduction limitation. Do it directly from the IRA, and then maybe even use a standard deduction. You certainly want to do that next year. Plus, the charitable donation amount counts towards meeting the required minimum distribution, the RMD rule. Once you get to 70 and a half, you have to take out required minimum distributions, which are kind of based on your life expectancy. Upper income individuals should be aware of the 2017 piece itemized deduction limitation indexed for inflation. So if you're over 261,500 single, 313,800 married in 2013, this piece itemized deduction wipes away many of your itemized deductions. When we had that fiscal cliff in 2012 after the Bush tax cuts expired in 2010, the Obama White House, they extended them for 2 years. Obama made permanent the Bush tax cuts for everybody but the upper 2%. And he socked it to the upper 2%, bringing them back to the 39.6% rate and bringing back this piece itemized deduction limitation. What's nice is that that will get repealed by tax reform, piece itemized deduction limitation. But they're keeping the 39.6% rate, the House. They're not going back to 35. They had blowback on that. But at least they bump up the brackets. So you got to make over 1 million married, 500 single. So the AGI percentage threshold for medical expenses is 10% for 2017. So next year you're not going to get your medical expense deductions. Bad timing, again, because a lot of people have high deductibles out of pocket. So if try to bunch them into this year, now it's hard to prepay doctors. You're not going to prepay medical bills. But if you have bills, get them paid before the end of the year if you think you're getting over the 10%, if you think it's going to help you. Because, again, the House bill repeals it for next year. Investment interest expenses are limited to investment income, and an investment interest carryover likely will be beneficial in 2018 since the House bill does not repeal it. I was really surprised to see them drop that out of the bill, which was a huge win for the investment management industry, and they kept the carried interest too, which they had talked about repealing. So if you have investment interest expenses, you can deduct it only to the extent of your investment income, which can include capital gains. Otherwise, it's a carryover. I was worried the carryover wouldn't do you any good, but apparently it will. Let's see what the final deal portends. Let's go to a really good area now. Capital gains and wash sale losses. Investors and traders should manage their income as best they can with tax loss selling and wash sale loss adjustments. Lots of investors and traders get tripped up and sometimes make the wrong decision, which can seriously raise their tax bill. Others make tax decisions which they can regret as being the wrong market decision. So you have to find the right balance. And I'm not giving investment advice. The House bill does not change capital gains. That's great. They had talked about originally in the blueprint that the lower capital gains rate may apply to all capital gains, which meant short-term too. I think that they just got their wording wrong. It doesn't. The lower rate doesn't help short-term capital gains. The House tax bill retains long-term capital gains rates, which are up to 20% in the highest bracket. Otherwise, it's 15% or zero underneath, including on qualified dividends. So you hold on to your stock for, the sufficient period of time and get the qualified lower rate. And they kept the 60-40 benefits in Section 1256, the 60% long-term capital gains portion of Section 1256, 60-40. We're happy about all those goodies that were kept. Now, unfortunate for you, we had this in our wish list that we sent Congress, and we had that petition that you all thankfully signed, but they didn't drill down to tax reform to this level. I mean, it's hard to tackle that much. So they didn't fix or change at this juncture that we see. We never know until the final stuff is done. But we don't see them touching the Section 1091 wash sale loss adjustments. Those are the headaches for you investors, where you sell at a loss, you buy it back, they make you defer the loss to the next year, and you're paying taxes on phantom income. We'll go into that more in a second, in a few minutes. They don't change Section 475 mark-to-market accounting for you trader tax status traders to get that tax loss insurance. That's good. We want that tax loss insurance. They did get rid of the NOL carryback. They don't let you get immediate refund. That's a bummer. And they don't touch 988 4X treatment, ordinary gain or loss, so you can make the 4X capital gains election. So, and they didn't even change the capital gains brackets, the rates structures. They didn't use the same bracket changes that they did for the ordinary rates. So they more or less didn't touch capital gains and losses, and they left in the investment management, the investment expenses. I'm just wondering, and they left in carried interest. I'm just wondering if they were afraid to monkey with things that could affect the markets. because these booming stock markets have been a big badge of honor for the Republicans, including our president. Tax loss selling. That's time honored. You see that in the financial media every year. Every writer knows that one. A taxpayer with capital gains can reduce taxes by selling losing securities positions so that they realize the capital losses before year end. If you have capital gains of $100,000 that you've taken this year, and you're going to have to pay taxes on it, and you're thinking about paying taxes in Q4, estimated taxes on it, and you're sitting there holding some losing positions that you've been obstinate about holding on to because you know you're right, that it is going to turn around, but it hasn't turned around yet. Think about, hey, take the loss. You're paying a tiny commission. Take the loss. Wait 31 days and get back into the position. And then you can have that capital loss in 2017 to lower your bill. Now, this continues to be a smart strategy in 2017. However, if you already have a capital loss limitation, the tax loss selling won't help. So you're sitting here, you have a $50,000 capital loss between this year and the carryover from the prior year. And they don't change carryovers either of capital losses. So you're already down more than the $3,000 capital loss limitation against other income. Selling something for a tax loss is not going to do you any good. It's just going to increase your capital loss carryover. So whatever you do with the tax loss selling, it's okay to do, but then avoid the wash sale loss transaction, because if you get back into it, it's going to be as if you didn't do the tax loss selling. Wash sale loss adjustments. Let me explain what that is. Be careful not to trigger a wash sale loss adjustment at year end. That's when it counts most in the taxable account, except with the IRAs during the year. I'll cover that in a minute. So avoid it at year end. You got to be careful not to buy back a substantially identical position 30 days before or after realizing a tax loss on a security. You have two accounts. You have your own individual account, you have a joint account with your spouse. You have IRA accounts. You have an investment manager account. You got a lot of accounts. People, online traders, they have a lot of accounts. And this is something to do with securities, not futures or Forex. Or if you're using mark-to-market as a securities trader. This is for the regular rules. You sell X symbol, and you take a nice big loss, and you're planning on to use it on your tax return. But you didn't realize that your outside investment advisor bought that symbol 15 days before or 15 days after. Or you bought it in your IRA. You triggered a wash sale loss adjustment. You don't realize it. It's not so apparent to you. You didn't do it on purpose. Now, in a taxable account, a wash sale loss adjustment from December is deferred to January, adding the tax loss to the replacement position's cost basis. So you have one account, you're single, you sell X on 12/15 for a big loss. You buy X on January 10th for the same amount of shares. You can't take the loss in December. It goes to your January cost basis. It's deferred. The IRS, wash sales for the IRS are economic rather than, cash. They're looking at the economic factor. So you don't want a wash sale because it accelerates income. It basically doesn't let you take your loss, which feels like phantom income, taxed at a higher rate. You're looking to delay the income. So you absolutely do not want wash sales this year. You never want them, but this year especially. You want to realize tax losses that are true economic losses. Now, it's not just about your tax. If you just have a taxable account, you can take a loss every day of the year. get out at year end, don't get back in for 30 days, and the wash sale that you kick the can on every day of the year that built up on you, break the chain at year end, and you get the full loss. Don't let the chain go into 2018. Now, this is not your only problem with wash sales. You also have to avoid wash sale losses with IRAs. If you realize a tax loss in an individual taxable account, a lot of people don't know this, a lot of local accountants don't know this. The IRS knows it. We want them to get rid of this rule because they're not really enforcing it. There's no cop on the beat, but yet if they ever have like automatic cameras, they'll catch it. But the point is, if you realize a loss in an individual taxable account and buy back a substantially identical position in a traditional IRA, even a Roth IRA for you or your spouse, if you're filing joint, you will never get the benefit of that tax loss. If it was just the taxable account, it would be deferred to next year. So it's a timing issue. That's bad, not the end of the world. This is catastrophic because you'll never get the loss. So if you trade a taxable account and also trade an IRA account, I highly recommend that you implement do not trade lists between your IRA and taxable accounts. So if you trade tech stocks in your taxable account, you don't trade those tech stocks or options on them in your IRA accounts. You trade other stocks. So again, on the taxable account, you want to break the chain on wash sales. In taxable accounts, avoid the wash sale loss adjustment at year end by breaking the chain. Sell open positions and don't get back into substantially identical positions for 30 days before or after selling them. For example, sell the entire position on December 15 and don't repurchase it until January 16. You may miss that New Year's, run up in the markets if they have that, but you have to weigh the wash sale issue versus the investment activity issue. So I'm not telling you to miss the action. I'm just telling you if you jump back in too soon, you got a wash sale. That may be, a better decision for you than missing the action. You have to make that decision. How do you figure all this out on all these different accounts? Here's how. In December, use trade accounting software to identify potential wash sale loss adjustments so you can break the chain before year end. Run trade log software or have us run it with our trade accounting service. We get that potential wash sale loss adjustment report and you see, hey, I trade 10 symbols. I got a problem in 2 of them. On those 2, I'm going to look to break the chain and I'll just try to focus on trading the other 8. Now, your headaches are not over. Broker and taxpayer rules are different. A lot of people say, I don't use software, I rely on my broker's tax reports. That will tell me what my wash sale problems are. Wrong. Don't solely look at a broker's tax report or a 1099-B for identifying potential wash sale losses. The IRS requires taxpayers to assess wash sales across all brokerage accounts, whereas brokers only look at a single brokerage account. Broker A, IB doesn't communicate with Fidelity. They don't merge their systems for wash sales. And they don't even do it across all accounts if you have IRAs, joint individual accounts. Brokers calculate wash sales based on an exact symbol. That's an identical position, whereas taxpayers must assess wash sales on substantially identical positions, which is an equity and its equity options at different expiration dates. Apple equity, Apple December options, Apple January options, they're all substantially identical. So you may think your broker you got away with a wash sale on by going from December options to January in Apple, but not with the IRS. This is why we advocate trader tax status and mark-to-market accounting. We don't want our clients getting spun in circles over these wash sales. With 475, they're exempt from that. Now, so if you have mark-to-market accounting, Section 1256 contracts, which include futures and broad-based indexes and other things, or you have Section 475 trades for traders with trader tax status. We've had separate webinars on that. They're both mark-to-market MTM. MTM imputes sales of open positions at year-end. So you're reporting realized and unrealized gains and losses. MTM negates the need to do tax loss selling. You don't need to rush to sell something before year-end if it's MTM, because you're going to impute a sale at year-end prices anyway. Of course, sell it if you think it's time to sell. MTM comes with 1256 by default, and Section 475 is, and 1256 is capital gains and loss treatment. MTM 475 is different. Individual TTS, trader tax status traders, they had to elect 475 for 017 by April 18, 2017, or have elected it in a prior year. So you can't just turn a switch on for 475 now. You already missed the boat. If you were an existing partnership or S Corp, you had to elect it back in March 15, 2017. The next opportunity to file a 475 election is for 2018 or within 75 days of inception of a new entity. And it's too late to set up an entity for this year end because you're not going to qualify for trader tax status in a month-and-a-half time period. I call 475 tax loss insurance because it exempts traders from the capital loss limitation and wash sale loss adjustments. If you have a big loss this year, because maybe you were a short seller or whatever, and you had 475, you're going to use that loss against every drop of your income without limitation, and you're exempt from the wash sale losses. Think about that for next year. The House, and I don't believe the Senate, is going to touches the net investment tax. The many investors had hoped that Republicans would repeal the Obamacare 3.8% net investment tax on unearned income, investment income, but they retained NIT in the health care bills and the House tax bill, and I believe the Senate does too. They were looking to repeal that as part of the health care bill. So you have to, if you're an upper income taxpayer, you have to deal with it this year. Consider reducing your income. We've noticed clients get really annoyed at that extra 3.8% tax on all their unearned income. It's like at the bottom of page 2, boom, 5,000, 10, 15,000. It's annoying. Just like AMT was always annoying. So if you're over the modified AGI threshold of 200,000 single and 250 married, and they never indexed it for inflation, that was unfair. You may want to defer. It's another reason to defer income. So remember, this year, the code is really muddled up. We don't have tax reform yet. There's a whole litany of AGI sensitive, dependent tax breaks for the middle income taxpayers. There are these upper income taxes where you get socked with the piece itemized deduction limitation, the net investment tax, the AMT. Try to get your income under these danger zones and into the middle income folk areas. Traders can manage income. They can do this kind of stuff. There's probably a lot of people deferring capital gains this year. You got to wonder its effects on the markets. Marginal tax brackets. Manage your income to avoid the top tax rates. Try to be eligible for those middle income tax breaks. Each of these tax breaks has different AGI, will make your head spin. Try to reduce your 017 AGI to maximize deductions for education, student loan interest, increased child care credits, personal exemptions, lower AMT, NIT. The House tax bill consolidates education credits, repeals personal exemptions, repeals AMT. I agree with tax reform for consolidating all this stuff. It can make your head spin. It's nice to be able to plan to get the benefits, but it's so confusing it's hard to do. Again, you need your draft return for that. Bottom line, get that income down, try to get into the middle class zone. If you think you're getting one of those credits or benefits, zero in on it. And definitely try to avoid the highest tax. You know, they kept the 39.6% rate, but this year it doesn't kick into 418, 400 single, 477,000 married. Next year it kicks in at 1 million married, 500 single. So at least they improve the brackets next year. So don't pay 39.6% this year if you can pay 35% next year. The House bill retained the top rate, and then I just went over those brackets. And it is nice to have consolidated brackets and better brackets. Remember, tax reform lowers rates, improves brackets, just gets rid of a lot of, expands the base, getting rid of deductions. Mostly for individuals, not that much, not as much for corporations. There are some surprises on the corporate side too. It's not all rosy. This is a hidden area that people miss. Maximize use of the 0% long-term capital gains. I find a lot of traders, they leave the job. They may have a very low income in a given year. This will turn everything I just said upside down. If you see you're in a 10% ordinary bracket or a 15% ordinary bracket, your long-term rate is 0. You definitely want to take some long-term capital gains, not short-term, long-term. So the long-term capital gain rate brackets correlate with the ordinary brackets for 017, not 018. They decoupled for 018. The 20% capital gains rate applies in the 39.6% ordinary income bracket. That's your highest bracket. Otherwise, you're probably paying 15%. That applies to all those other brackets between 15% and 39.6. So all those middle brackets are the 15% capital gains rate, but most people forget is that the 0% capital gains rate applies for the 10% and 15% brackets. So if you're in the 10% or 15% bracket, sell everything if you don't mind selling it, because you're going to lock in a 0 rate. Now, you'll have to pay state taxes probably, but again, you're in low rates. This applies to your 60-42. If you're in the 10 or 15% bracket, do you know what your 60-40 rate is? It's 40% in the 10% bracket, because 40% is taxed at 10%, that's 4%. The 60% is 0. And then it's 6% in the 15% bracket. There's no sense postponing income, folks. If you can pay such a low rate, grab it while you can. Now, we're not going through everything today. We left out all the business planning. We're going to go over that in the next webinar. There's no room on the IB schedule. It would be too late, like around the holidays. So we're going to do that at GreenTraderTax. We're going to have a business webinar. But here's a few other things: IRAs, solo 401k, employee benefits, and estimated taxes. You want to maximize your retirement plan deductions for greater tax savings, and you need to deal with the estimated tax rules to avoid underpayment penalties. I saw an article in the, I think it was the Wall Street Journal yesterday, that underpayment penalties have skyrocketed. The IRS is making a fortune off of that, folks. That's making it off of you. Probably because the underestimated tax rates are very low rate because of the low interest rates. And people think it's less than a margin loan or a mortgage loan. So the people want to hold on to their taxes to keep investing it. But they're paying large estimated taxes. And it doesn't have to be that. There's a couple of tricky things you could do at year end to beat the IRS and not get a bill. Now, you need to do your required minimum distribution if you're for IRA, solo 401k, and employer retirement plans. Commence the RMD by April 1st of the year following the calendar year in which you reach age 70 and a half. You can start it sooner. If you don't, you got to double up, but it's a little tricky on how they do it. Just make sure you do your RMD on time. Otherwise, there's a 50% excise tax penalty on the amount you should have distributed but did not. Avoid estimated tax underpayment penalties. Many traders and small business owners don't pay quarterly estimated taxes in Q1, Q2, and Q3. Since they might lose significant money in Q4, and they figure, why should I prepay when I might not really owe it for the year? I'm going to wait until later in the year. So there are strategies to avoid that underestimated penalty. So maybe you do make a Q4 payment, but you might have a penalty for Q2 and Q3. Or in Q1 too. We usually have clients overpay their extensions and returns to leave an overpayment to cover Q1. Here's what you can do. You're an investor, you're a trader, you also have a job. Go to your employer and say, listen, I want you to increase my federal and state tax withholding on my November and December paychecks before year end, because the IRS and state is going to treat that W-2 tax withholding as being made throughout the year. Bingo, you just avoided the underpayment penalty. I didn't put in here, I originally had it in there, but I don't want to confuse people, but you can take a distribution from a retirement plan, do a direct rollover, but have them withhold, or indirect, have them withhold taxes. You won't have to pay the tax on the income because it's going to be a rollover, but yet there is additional withholding on a 1099-R. Consult us about it if you want. Also fully fund your health plans. If you haven't paid in the full amount to your health savings account, $3,400 self-only, $6,750 family, $1,000 more for catch-up over age 55. Get those funds in there. Increase your employer's health flexible spending account for 2018 if you had too little funding. Maximize your retirement plan deductions. Now, I'm going to cover this more in the business area, but I wanted to throw it in here. If you got a solo 401k, you want that $18,000 in the payroll. You want to put in place enough payroll to do the 25% deductible profit sharing plan. There's a $54,000 deduction on the line and $60,000 if you're over age 50. I'm going to cover this one more on the business planning one. If you're doing an Roth IRA conversion, it's a great thing to do every year. Let's say you're in a really low rate this year. You're in a low tax bracket. You're not looking to defer income. You're in a really low bracket. You left your job in 2016. You've been investing in 2017. You haven't done that great. You're just in a low bracket. Why not take advantage of the low brackets? You're expecting to be in a higher bracket next year. And it may be in retirement years, to soak up the lower brackets. Consider a Roth conversion before you got to do it before year end. Because once the money goes into the Roth, it's permanently tax-free. You'll never have to take a distribution in retirement, and you can even pass on the benefit to your children, although they will have to have RMDs. You won't. So it's permanently tax-free versus the regular IRA, which is only temporarily tax-free. Now, here's the thing about the Roth. If it drops substantially in value afterwards, you can reverse the 017 conversion by October 15, 2018. Get it while you can, folks, because the House tax bill repeals the reversal option. They thought too many people were gaming the system. They would do the conversion. If the account went down, they reversed it. If it went up, they left it. They want to get rid of the gaming of the system, but that won't apply until someone does a 2018 conversion, and they want to reverse it in 2019. That won't be possible. This is your last chance to do it with the reversal option. So many of our clients have done this because they knew that they could reverse it, and many have. This is a wonderful thing to consider for a trader especially. Imagine holding a Roth IRA that has a lot of money in it, because it's hard to build it up, but to have a conversion with a lot of money in it, tax-free for life as you make nice returns, compounded tax-free, pass it on to your children as an inheritor Roth IRA. It's a wonderful thing for traders and investors. So give that some consideration as well, and consult your accountant about it, consult us about it. So again, I'm going to have the year-end planning webinar for business entities. I'm going to update our blogs on our website, as every time there's a change in the tax reform, for example, the Senate bill, the deliberations, look for updates on our website. Stay tuned. We will walk you through the best decision-making to do before year end. So let's look at some of your questions. Come over to the GreenTraderTax.com website, give us a call, send us an email, do a chat with us. Let's look at some of your questions. And by the way, on the website, read these blog posts about the ones I was telling you. There'll be new ones coming up. So Let's look at some of your questions. And I'm just opening that up here. So get your questions on. We usually run a little late and try to answer some of them. Let me just drink a little water. All right, so it does not apply to Canada. This is U.S. tax planning. Thank you for nice compliments, some of you. Expenses repealed, meaning being taken away. Yes, Mike M. When they repeal an expense deduction, that means that there'll be no way to deduct it. You will not be able to deduct state and local income taxes, and maybe not property taxes, or capped at $10,000. Now, yes, Mike M., in the blog post I point out a really nice thing about the state and local, and I'm glad you prompted me on this question. When I read the House table of contents, it said state and local income taxes that are not business. They were inviting us to apportion some to business, Schedule C or Schedule E. That's in my blog post. So read those blog posts, the impact on traders and investors that I just showed you on our website. So let's say you got $50,000 of state and local, including property, and the whole thing is repealed on Schedule A. But your business income is 70% of your total income. The other 30% is non-business. We might be able to allocate all that over to your Schedule C and or Schedule E. That's a wonderful thing. Consult with us about it. We're going to, you know, once they change the tax code, accountants get to work figuring out what's possible. And it seems like they were inviting us to do that. They want business people to do well. Susan, if these bills go through, will they be retroactive just going forward? It's all 2018 with the exception of expensing. Businesses get beefed up expensing, millions of dollars more. Traders, smaller people always had beefed up expensing, but they beef it up even more. And they want that to start when the House bill dropped on November 2nd, when the framework, the unified framework came out on September 27th. Why do they want to make that retroactive? That gooses the economy. They want businesses spending money right into this year end to get an immediate benefit for capital investment. They want that investment in the economy right away. But the lower corporate rate the House doesn't give until 2018, and my understanding is that the Senate, and they may have already come out with the news by now, my understanding is that the Senate may delay that lower rate for the corporations to 2019. That's just to monkey with how to pay for it and not go over the $1.5 million placeholder, $1.5 trillion deficit placeholder in the 2018 budget. So again, it's 018. The only adjustment is expensing and also the mortgage cap change. They did that the day the House bill dropped because they didn't want people to game the system jumping out to get a large mortgage before the end of the year. HA, any change to 1256? No, I'm really happy. I was kind of worried that they would hurt our clients, hurt our business, but our area remains intact. All the things we do work for 017, work for 018. Trimming itemized deductions doesn't trim the gravy, the icing on the cake that we deliver to our clients. Now, we had hoped that our clients would get the lower pass-through rate of 25%, which is a mirage. It's really 32% for a 35% bracket or 35% for a 39.6% bracket. That's if you're a manufacturer. If you're a service company, you don't get any benefit of the PT rate from the House bill unless you have a large capital investment factor. And traders get nothing because they don't have business income. Maybe the Senate, I think, is expected to fix that a little bit. But again, I think traders are left out. But at least traders keep all the good stuff they've had in the past, like 1256. Democrats had thought 1256 was a loophole. Remember, I defended that in the New York Times, and I went up against Warren Buffett on that. He threw it under the bus, and I defended it. You can read that article on our website. Any chance donor advisor funds? I don't want to get into that. That's a little beyond the scope of this. I'm not sure what you mean by that. AC, earned tax losses, real economic losses. So are your expenses. It's always been unfair that individuals have real expenses. But again, they figure if it's not business, why should they allow it? They're trimming individuals. They're giving it all to business. What always upset me is businesses figured out ways to deduct expenses that were phantom, and good, honest-to-do people couldn't deduct their real expenses. Is it possible to obtain trader tax status for 17? Yes, you can go back, look at the year. If you rose to the level of qualification, go back and read my blog post, watch the webinar recording. It's on the IB site. You can claim it for 2017. There was no election for that. And you can claim it for next year. We don't see any changes there. Any changes to tax treatment for cryptocurrencies? Yes. Now, you know, if you read our cryptocurrency content, which is extensive now, we have a lot out there. I even call it Green's 2017 Cryptocurrency Tax Guide. It's on the website in the Tax Center, under Tax Treatment Other. I said like-kind exchanges don't work for coin-to-coin trades, and I explained why. Well, this bill actually limits like-kind exchanges, 1031, only to real property. It does not allow it for collectible coins, real, like, precious metal coins, or art. So they have trimmed back quite a bit the like-kind exchange. They felt that was being abused. CW, when is the latest date to reverse an IRA for a Roth conversion? That was made in 016. It's too late for the 016. So if you do an 017 conversion before the end of this year, you can bust up your IRA into smaller pieces and then do the conversion of one of those. Then you'll go on extension next year on your 017 return until October 15, and that's the date, the last date you can reverse it. You can reverse the 017 Roth conversion by October 15, 2018. You will not be able to reverse a 2018 conversion because the IRS gets rid of that. The House gets rid of that. RH, for an investor with only investment income, does 475 have some risks? Well, you can't elect 475 unless you have trader tax status. It gives you ordinary income. So if you have a large capital loss carryover from your investing days, you don't want ordinary income. You want capital gains income. So you have to go into 475 at the right juncture. And there, you can also revoke it. You need to read our guide about that and consult with me about it. CL, in the upcoming business webinar, could you discuss sense of S Corp, C Corp management? Yes, all that. And that's in my blog post too. By the way, some people thought they may want to jump into a C Corp to get the lower rate. If the Senate delays that one more year, you're not going to jump into it for 018 right away. And anyway, if you have a management company C Corp, it's a personal service corp at the 25% rate, not the 20% rate. And with double taxation, it may not make sense. I touch on this a little bit in the blog post on the website about the past due entities. See that in the recent blog post. So you want to, let me just show you. You want to open this blog post and read that post. And it's all in there. Okay, let's go to the next question. KW, if you have a $2 million regular IRA and no income in 017, soak up the lower rates. Take advantage of some nice low rates. If you're a good trader and investor, if you have no income, you're wasting your itemized deductions. You're wasting the standard deduction. You're wasting the exemption. You're wasting the 10%, the 15% rate. Soak it up. Do enough. Bust up that IRA. Soak it up. You got the reversal feature. And maybe do it even again next year, even without the reversal feature. You definitely want to do it. Managing income is to avoid the highest rates. It's also to use the lower rates and not to waste your standard or itemized deduction. Some people have multiple questions here, like CL, about the entities. We're going to do that on the next time around. Can you speak to this? Is it true that many brokers do not report equity options as a wash sale? That's correct, because brokers are reporting wash sales on an exact symbol. Apple December options has a different symbol from January options, so they're only doing it really between equities per account. If all you trade is equities and have one brokerage account, you can rely on your brokerage reporting, but if you have multiple accounts and or trade equities and equity options, you need the software to do it right. One of these days, people are going to get busted over this, and the IRS will use the software to do it right. But for the most part, industry practice has been to cut corners from other, and they have not gotten busted yet. But that happens, the IRS catches up with people. All right, DK, carrybacks 1256, that's still allowed. You can carry back a 1256 loss for 017, 3 tax years, but only against 1256 gains. I didn't see any of the bill language that got rid of that. They did repeal the NOL carryback, the net operating loss carryback, unless you have disaster relief. So they allow unlimited carry forwards, but that's not a good deal. I don't mind having a 20-year carry forward versus unlimited. I really wanted that NOL carryback. My partner pushed for that on the AICPA task force, Darren Neuschwander, but they didn't do it. They're trying to protect the Treasury. That's really unfortunate, because when people don't get an NOL refund, they may fire workers. That helped replenish businesses. So much of this tax reform is not a Jobs Act. They're giving incentive to buy capital equipment because you get upfront expensing. You can get a better PTE rate because you have a higher capital. You're avoiding payroll taxes. This bill is better for investing in automation and robots than it is in jobs for people. IP, what is the level of qualification? That's in prior posts. FL, if we pay green for 2018 work or 2017, can it be claimed? Yes. So you just go out and purchase our retainer or advance payment, and you get that deduction this year. Now, if you know you have trader tax status next year and you have no business this year, you might want to wait till January to pay it. We'll have, but otherwise you want to prepay it. You want to do your year-end planning. CW. Is there any benefit to incorporating to qualify? Yes, that's when you get your health insurance and retirement plan deductions. And the House threatened to cut back on the 401k from $18,000 this year. Well, next year it's $18,500 to like $2,500, but they caved. They left it in place. Let's see what the Senate does. Hopefully the Senate doesn't rein that in. And they haven't reined in health insurance, but let's see what happens with the Senate bill. So a lot of our strategies work fully for 017 because changes are not in effect yet, and they should work great for next year too. That's my upfront thinking. Thank you, Hervé, for the nice comment about the webinar. Appreciate that. So CLM get back to us. Yeah, the S Corp gets the maximum solo 401k deduction for 017, and when you read my pass-through post that I have in front of you, it gets it for 2018. By the way, another real sneaky thing in the bill, the House bill, they jacked up the self-employment taxes for the pass-through limited partnerships, for rental income, for the active owners of S Corps and partnerships. They beef up the self-employment tax, which is something that we always try to avoid or limit, but not for our traders. So read about that in the blog post. That got all the questions out there. Yes, the recording will be up. IB will make the recording posted on YouTube and their site. So thank you all for coming. Just let me quickly show you around the site quickly. So just come to the website in the Trader Tax Center. You have all those drop-down areas to look at. It's going a little slow here with the connection. You can look around yourself. Give us a call. We hope to work with you soon. Again, whether it's with us or your local accountant or on your own, start getting your act together on the year-end planning. Stay tuned on our email list to get blog updates about what's happening with tax reform and the advice I'm giving our clients so that you have everything you need to know to make the best decisions possible. Thank you, everyone. And right after this, I hope to tackle the Senate plan and have up something in a few days about it. Back to you, Cynthia.
Okay, well, Robert, thank you so much. You covered an awful lot, and today's event has been terrific. Now, what I do want to let everyone know, we have been recording today's session, and you'll all get a direct link to today's recorded playback soon after we close this out. So do watch your email, your inbox later on today for not only a direct link to our recorded playback, but also I'll be including the slides in that follow-up message as well. By the way, Robert's done quite a few webinars for us this year, and you can find those listed on the Interactive Broker website. Underneath the education menu, you'll find a webinar section where you can go into the recordings and actually even search by Robert's name to find all of the events that he's previously done. Today's event will be posted there as well. But also just keep in mind to watch your inbox later on today for a direct link to today's information. So once again, Robert, thank you so much. I know you put a lot of work into this, and we all do really appreciate it. And I also want to thank all of you for participating with us today. Have a great day, everyone. You can exit today's session by simply using the X that's included in your control panel title bar. Thanks all. Have a great rest of your day. And thank you, Robert, as well.
Thank you.
Have a good one.